Welcome to this video series about measuring value creation in private equity, where we talk about how the market versus the manager drive private equity returns. My name is Mike Reinert. I've worked in the industry for 15 years. I run the AUXILIA Mathematica website, and I wrote the book Private Equity Value Creation Analysis. These videos cover findings from my work website and book, and they're designed for private equity practitioners who use data to raise capital or evaluate the returns of private equity deals, funds, GPs, and investment programs. If it's helpful to you, subscribe and check out the website where you can download the Excel files behind every episode. This is video number 11 in the value creation series, where we finally start to look at how broader market forces drive private equity returns. This is important because private equity investing is relatively expensive for both GPs and their LP investors. From the LP perspective, they're dealing with high expenses, 2% management fees, 20% performance fees, and illiquidity. Once they make a fund commitment, they're typically stuck with it, for better or for worse, for at least a decade. From the GP perspective, they're working on complicated, privately negotiated deals without transparent valuations. There's high fees to intermediaries who facilitate the transactions, and they require a lot of spending on lawyers, accountants, and other service providers to understand companies and form value creation plans. So it's important to show that all of this cost and effort is worth it, and there's two dimensions to that. The first has to do with investment manager skill. Is the GP or LP really creating a differentiated risk-reward profile that makes up for all the fees and the complications? And the second has to do with opportunity cost, making sure that the return could not have been replicated more easily with cheaper and more liquid alternatives like an index fund. Now, one way to look at this is with a technique called public market equivalence, or PME. This has been around since the 1990s and was established by Austin Long and Craig Nichols. It was originally called the index comparison method, and it was described in this 1996 paper that you'll find frequently cited in academic literature. There's links to it in the description on the website. There are now numerous adaptations of the original, Kaplan Scholar PME, PME Plus, MPME among others, and these were all created to deal with numerous mathematical quirks that often arise from the original. But they all really try to do the same thing, that is to measure the opportunity cost of the cash flows of a private equity deal, fund, GP, or investment program. A simplified example of PME is as follows. Here we have the cash flows for a hypothetical fund. We see that they're quite irregular, with negative inflows predominant in the beginning of the holding period, and then positive outflows from distributions beginning to occur a few years later. Here at the end, we have an unrealized net asset value, or NAV, of $60 million. To measure the hypothetical fund's return, we can divide all the outflows by the inflows to get the multiple of invested capital of 2.27x, and we can use the cash flow series to measure an internal rate of return, or IRR, which is about 33% here. Now, a PME analysis would ask, what if every time the fund calls capital, we buy an equal amount of shares in an index like the S&P 500, and then every time the fund distributes capital, we sell or short an equal amount of index shares. This would give us the same exact inflows and outflows through 12/31, but the NAV would be different. Here the NAV is $30 million, which suggests that the fund cash flows have outperformed the opportunity cost of the index. We can now calculate that opportunity cost directly. It would give us a multiple of invested capital of 1.73x and an IRR of about 25%. And this says that the fund outperformed the index by about a half a turn of invested capital and 7 or 8% of IRR. That's what PME does. It gives us a comparable return measurement that's adjusted for the uniquely irregular cash flows that you find in private equity deals, funds, GPs, and investment programs. Now, this is undoubtedly a very clever way to measure opportunity costs, but the spread is often interpreted as private equity alpha or investment manager skill, and I think that's a bad interpretation. First of all, private equity deals behave differently than companies that make up an index like the S&P 500. For example, they're usually much smaller, and they cater to niche markets. Second, the private equity returns and PME returns are both downstream from leverage. When you compare the two, the difference represents a combination of both operational performance and debt's amplification of equity gains and losses. You're not just looking at what most people would consider the GP's value add. Third, there's a timing and volatility mismatch because public company share prices change every minute. It could take 2, 3, or even 6 months to close a private equity deal, so what's the right date to use for that PME share price? Should it be the indication of interest date, the letter of intent date, the closing date, funding date, or 6 months later when the GP actually calls capital from the LPs because they use a fund credit facility? That choice can have a serious impact on your PME number. And four, there's various other practical and mathematical challenges. For example, the public companies often have dividends which aren't reflected in the index price. Basing an analysis on IRRs is difficult because they can be quite volatile. You really shouldn't be adding and subtracting IRRs. And in general, cash flow driven analyses like this really don't scale that well. The models are difficult to maintain. Now, there are ways to fix these issues. You might be able to better measure the market dynamics for a private equity deal by using a niche ETF for an index instead of the S&P 500. Capital structure differences can be corrected by unlevering both the deal cash flows and the public market cash flows with formulas like those in the Munich model of value creation we discussed in VC111. And you can smooth out index volatility by taking a simple moving average over 3 months, 6 months, or whatever date range is most appropriate for the deal. However, I'll make the case that the value creation models that we've been discussing over the last 10 videos, not only do they give us a better and more meaningful measurement of GP value add, they could do it with a lot less data and a lot less work. Here's an example of a company where we break the total equity return into 5 distinct value drivers. Revenue growth is driven by the change in the company's revenue. EBITDA margin expansion is driven by the change in the company's EBITDA margin. Multiple expansion is driven by the change in the company's valuation, measured as total enterprise value over TTM EBITDA. Cash flow generation measures either debt paydown or cash accumulation on the balance sheet. And gearing tells us how much extra equity value is gained or lost because the company had debt in its capital structure. We described all of these value drivers over the last few videos, and you can download the Excel template for this on the website. Now, if we have a sense for changes in the company's addressable market, we can break revenue growth into addressable market growth and market share growth. If we have a sense for prevailing market multiples, we could break multiple expansion into market multiple expansion and intrinsic multiple expansion. And if we have opinion about what the appropriate leverage level would be for a company in the sector, we can break gearing into sector gearing and excess gearing. Theoretically, you could do the same thing for the EBITDA margin, but for reasons that we'll discuss later, that is usually not as meaningful or worth the effort. These 3 value drivers capture the most important market influences, and you can add them together to estimate the market-driven return and the manager-driven return as we see here. While PME is certainly the best way to measure the top-down opportunity cost of investing into something that is not the private equity deal, this will always give us a better bottom-up measurement of the market influence in GP value add within the private equity deal. It tells us how the market influenced the company's P&L and valuation, and there are no discrepancies driven by different debt levels because revenue growth and multiple expansion have already been unlevered with the average holding period equity ratio. And if you wish, you can plug in a sector debt level to precisely measure how much extra gain or loss was driven by the deal's departure from the typical sector leverage. Now, I'll derive and prove the formulas for this in the following videos, but to show you how easy this can be, I want to give you an idea of the kind of data you need to build a chart like this. Before we do our market splits, we have 5 value drivers: revenue growth, EBITDA margin expansion, multiple expansion, cash flow generation, and gearing. To build this, we only need 4 metrics. They are the entry and exit, total equity value, net debt, revenue, and EBITDA. And that's it, only 8 numbers per company. To break out addressable market growth and market share growth, you need an estimate of how much the company's addressable market changed over the holding period. I use beta sub R for that. It's a number that you might take from an industry expert report like Gartner or Forrester, or you might estimate it from economic data. For example, I've used the US Bureau of Economic Analysis website in the past, where you can download decades of free data providing gross output by industry sector. To get market multiple expansion and intrinsic multiple expansion, you just need the prevailing market multiples at exit and entry. That's 2 more numbers. Here, I would tend to look specifically for private equity M&A multiples rather than public market valuations, although those can work as well. Many rely on services like PitchBook for something like this. And several of the investment banks publish reports with data in this area. R.W. Baird's M&A Outlook is a good one that I've used in the past. And then for the sector gearing and excess gearing numbers, you just need to look at a few comps to decide what debt level you think is appropriate. The number that you need is the average sector debt ratio, or net debt divided by total enterprise valuation for the typical sector peer. I would probably look to Capital IQ for this one, but you could probably figure it out on Yahoo Finance. So if you add the 4 market numbers to the 8 capital structure and P&L numbers above, that means we only need 12 numbers to make this chart with 8 different value drivers. And you see that doing it this way gives us a lot more flexibility and control in tailoring these metrics to the industry or sector of the private equity deal. Okay, we'll talk about the math and what makes a good metric in the following videos, but I want to circle back to the comparison between the value creation model and PME. I'll do this with a highly oversimplified model where we look at the decision-making hierarchy for various private equity participants. And we'll try to match the accountability metrics with the things that the participants can actually control. Here we have Alice. She's the treasurer or chief investment officer. She must make a lot of big decisions, and let's assume that one of them is determining what percentage of the portfolio should be allocated to private equity. Now, this is an area where opportunity cost makes a lot of sense as an accountability metric. If PME says that private equity cash flows outperform the public market, then clearly Alice allocated too little to private equity. However, if PME says that the private equity cash flows underperform the public market, then clearly Alice allocated too much to private equity. Unfortunately, that's a lose-lose for Alice or the consultants that advised Alice, but it does line up with Alice's decision-making scope. Now, what about Bob, a portfolio manager who reports to Alice? In our oversimplified model, he sources private equity funds, builds relationships with GPs, performs due diligence, and recommends opportunities to the board or investment committee. Bob has no discretion to invest in public markets, so public market opportunity cost measurements like PME tell us very little or anything about his investment acumen. Bob's job is to fill the organization's private equity allocation with better than average private equity funds, and that's how he should be judged. So to measure this, you might look at how his program or his managers compare to those of other peers, or use private equity industry benchmarks like those from Cambridge Associates to see how Bob's performance stacks up. Okay, further down the line, we have Carol, our private equity GP. Her job is defined by a 300-page document called a limited partnership agreement that she negotiated with Bob. It says that Carol must invest in complicated privately negotiated transactions with predefined size and growth characteristics operating within specified geographies and industries. That LPA specifically prohibits Carol from investing in public securities, so the PME measurement makes very little sense here. Why measure the opportunity cost of something when Carol doesn't have the opportunity to invest in it? The things that Carol does control are her target markets, entry valuations, equity structures, debt levels, and the results of whatever value creation plans she puts into place. The best way to measure these things is to use the value creation models that we have been discussing in these videos. Capital structure changes can be explained by fund ownership impact, the leverage effect, gearing, and cash flow generation. P&L changes can be explained by EBITDA growth, revenue growth, EBITDA margin expansion, gross margin expansion, and operating margin reduction. Valuation changes can be explained by multiple expansion. And these measurements will get even better as we break out how broader market forces influence them. Finally, we have David, the company CEO. He's even further removed for what's happening in the market. We'll hold him accountable for things like sales execution, operating performance, and cash management. And this is another area where value creation analysis can tell us a lot. Okay, to summarize then, when you try to line up the accountability metrics with the day-to-day decisions of the private equity participants, I think an opportunity cost measurement like PME is more applicable to participants at the top of this chart for CIOs like Alice, and maybe a portfolio manager like Bob. It's a better measurement of LP investment acumen instead of GP investment acumen. If you want to understand the drivers of company performance or GP value add, so you can assign credit or blame to a fund manager like Carol or a CEO like David, then the value creation models that we've been discussing in this series give you a much better picture of what's happening under the hood. And those measurements will become even more meaningful as we break out the broader market influence on value drivers like revenue growth, multiple expansion, and gearing. So stay tuned, we'll tackle that over the next couple of videos. Thanks for watching. If you're into this sort of thing, subscribe and check out the website AUXILIA Mathematica. Registration is free and allows you to download Microsoft Excel files with all the data and charts used in these and other videos. On the site, you'll also find other resources like articles, templates, and a private forum for Q&A. When you visit, check out the site's free online value creation calculators. These web pages allow you to select various analysis parameters, plug in your own capital structure, P&L, and market data, and then measure value creation with a click of a button. I don't think that these calculators will replace your Excel models, but they're really useful for both preliminary investigations and double-checking that your own spreadsheets are generating the right numbers. I should mention that if you're looking for a convenient reference and training tool with a form factor of a college text, make sure to check out my book, Private Equity Value Creation Analysis, on Amazon.com. And finally, if you'd like to get up to speed with models like this more quickly than the book or the website allow, get in touch. Over the last 15 years, I've helped dozens of GPs build models like this for various fundraising and investor relations projects. Thanks for watching, and see you next time.